Do you really know and understand how the Federal Reserve works? Hey, I'm Justin Hitt with Sustainable Wealth Secrets. I'm going through some old content and really just cleaning up my library of materials from more than 22 years of newsletter publishing. And I came across materials that say what the Federal Reserve doesn't want you to know about how interest rates work. And it got me thinking about how inflation is going today and how the news talks about it as if it's something new. And really, this article was written in 2018, and I've written other articles about inflation in 2008. I want to share with you some key principles when we hear about interest rates being raised at the Federal Reserve, and we hear about inflation, and we hear about stimulus checks, what's actually going on. So it's almost guaranteed that if there's high inflation and high unemployment rates, that the federal government, in the United States at least, and most governments, are going to try to lessen the blow as it impacts their voting bloc. They're going to offer stimulus. They're going to offer tax credit programs. They're going to offer different incentives in order for people to feel like things are not as bad as they are. The Federal Reserve will increase rates to try to slow down the economy, which that contraction will put less money in circulation. How does money get to be in circulation? Well, either the federal government prints it or they lend it into the financial system. So banks don't just get free money from the government. They get money from the customers, which they're allowed to leverage a certain amount to write loans. The writing of those loans actually creates money. Same thing with the Federal Reserve. They'll go literally print more money, and then they will loan it to the Federal Reserve banks, which will then in turn loan it to government agencies and such, and we're in effect creating money. Now, when you're creating money out of thin air, the intrinsic value of the goods and services that the money buys stays the same. And what do I mean by that? Well, if we went back 100 years and we bought something with a 1 ounce piece of silver, and then we bought something today with 1 ounce piece of silver, the buying power of that 1 ounce, that silver doesn't functionally change. That 1 ounce is still an ounce. It's still 0.99% pure silver. That hasn't changed, but its buying power has changed, and that represents inflation. So the Louisiana Purchase, each acre cost about an ounce of silver. At that time period, you can't buy an acre for an ounce of silver today. You can buy an acre of land could be between $3,000 and $21,000, depending on where it's at. An ounce of silver is only worth like $40-50. So we have inflation in place because a unchangeable commodity item over a period of time buys different amounts of goods. Now, again, the Federal Reserve printing money is going to cause these problems to happen. When the U.S. government gives away money to other countries, we don't actually send them a truckload of money. We lend them money, which we're creating currency. We lend them money, or we have trade agreements that are tied to the money itself, and those other countries either have to pay it back or they're on some kind of agreement to take certain actions in turn for the money to be forgiven over time. I don't have the book off the top of my head, but there's a couple great books about this that talk about how we use lending in order to enslave or to bind other people into an obligation. So essentially, when you take out a mortgage, you're getting a house for use, but you're promising future earnings to the bank in turn for that house. So people tend to buy bigger houses than they need, and they end up having more of their future earnings proposed to the government. Now, there are times where you can borrow money in a low inflation environment and then pay it back with inflated dollars. That's something we talk about in the debt management plan. But the key is we want to understand the interest rates of what we get for our money. So if you have money and cash in the bank, you want to make sure that you're getting paid a higher interest rate on that cash than the current inflation rate. Now, the inflation rates provided by the government don't tend to be the inflation rates that are used in businesses. If you take a finance class, you'll see that you calculate an inflation rate based on opportunity cost, based on a low risk investment, based on inflation numbers in your industry. But my point being is, when you're borrowing money, you're pledging future earnings and therefore indebting yourself to do what someone else wants you to do. You're then impacted by inflation because if you have a demand for borrowing and the Federal Reserve increases rates, it makes it harder to hold that to get more money or more loans. So for a business, for example, that has to refinance its loans periodically, and we've talked about this in another program, your business might have 4 or 5 loans. You refinance those loans, you might get a better payment, but that's harder to do when interest rates are going up. You may have idle cash in the business, such as cash reserves, emergency funds. This is the same thing for your household. If you're earning 5 or 4% on that money and the inflation rate is 8%, then you're actually losing money on that cash. So you have the same dollar amount of cash, but it has less buying power in the marketplace. So I'm going to share with you 2 strategies that we can use during inflation. Number 1 is when inflation is high and you've retained your income, you want to pay off all your debt. So when interest rates are very low and you've got surplus cash flow, we're accumulating debt to the point in which we could pay off with cash right away. And then we're paying that debt off completely when inflation rates are increasing, because debt might have a 5, 10, 20% interest rate on it. And by paying that off, you're earning so the idle cash in the bank's getting 5%, but you're paying off a 20% credit card, then you're actually earning a little bit of money. But again, because you've pledged your future earnings, you're not really getting anything out of it. So keep your debt as low as possible. If you do need to take on debt, you want to make sure you take on debt that has positive net cash flow. So a mortgage on a home is not a very wise borrowing scheme, but it's very common. And it depends on what's going on. It's not necessarily bad, but a loan on a rental property is completely different because the cash flow from the rental property will pay the obligation rather than pledging your future earnings. You're basically pledging through the service to your customers, pledging someone else's future earnings. The Federal Reserve itself will increase rates. You can increase rent. Everything balances out just fine. Another factor to look at is that as rates are trending one way or another, you want to shift your free net cash to, again, pay off debt when you can use inflated dollars to pay down old debt, but also to look at investments that are commodity-based, because even though they may not increase in value very fast, the underlying commodity doesn't lose its value. Now, I'm not saying buy gold, buy silver, buy platinum or anything like that, because those items don't have cash flow. I'm more leaning towards land, real estate, businesses, equity in businesses such as that, because they have an upside available to them. They have a potential to cash flow their individual investment. I know I'm covering a lot of different things here, but when you look at the Federal Reserve, they are manipulating markets. They're trying to pick winners and losers. They're trying to dial back, and they even use it in their language, dial back the economy to slow it down a little bit. What does it mean when the economy slows down? Well, it might mean it's harder for you to earn income. It might mean it's harder for you to stay employed, because if costs are going up quickly, employers will start laying people off. So when you have an emergency fund, you want to go past the emergency fund and be looking at how much food do you have? Are you prepared for, if there was a heavy winter storm coming along and you got stuck in your house for a month, do you have a month's worth of food in your house? If you even go out to ready.gov, there's a lot of recommendations there to have 3 months worth of food on hand. Are you able to maintain clean water? Now, I know this stuff sounds like prepping, but it's the practical element, because that bag of rice that you bought or that food that you bought may actually if you buy it now, it may appreciate faster than your investments because food costs are going up. I'll give you just one practical example. I was buying a 25-pound bag of rice. We eat a lot of rice. And at the time, my wife was like, why are you buying a 25-pound bag? Just get a regular bag. We don't need a 25-pound bag. And I think at the time, it was $7 for a 25-pound bag of rice. And so I bought it anyway. because we eat a lot of rice and I don't like to go to the grocery store. But the next time we went to the grocery store, guess how much that bag of rice was? It was $15. And so my bag of rice within a 3 to 4 month period doubled in value. And even today, a 25-pound bag of rice is almost $1 a pound for rice these days. I can assure you that prices will always go up. They won't turn around and come back down. So from a wealth creation perspective, you want to buy assets that cash flow. You want to be mindful about when to borrow and when to pay off debt. You want to be mindful that what your cash is doing. Your cash just can't sit in the bank. It's got to do something. Again, we talked in other programs. You want your cash to circulate in the economy. You want to keep it moving, keep it working, and produce net free cash flow. Another factor to consider is that the Federal Reserve and those people are not going to be rational about all this stuff. The government's not going to be rational about all this stuff. The government is going to lend money to other countries because there's political motivations. They want to look good. They want to gain control. They're going to give out stimulus to people because they're buying votes. Every time we come into an election cycle, they're giving out money trying to buy votes. These factors you can't control. What you can control is your understanding about how the system works, what you do with your cash when it's not being circulated, and the application of financial resources into different types of things. So, for example, if you don't have proper insurance on your home, or you don't have proper health insurance, or you don't have proper life insurance, you're going to have a bigger problem than if you buy the right investment. Because if you do have a situation where you end up with $25,000, $50,000 in medical bills, that's going to be far more of a burden than worrying about how much money you can or you don't have to put in the stock market. I know this can be a complex issue, and we can talk about it specifically in more detail in another program. I'm Justin Hitt with Sustainable Wealth Secrets. The key to what we're doing here with Sustainable Wealth Secrets is giving you insights and concepts to help you keep more of your money, to become a money master. Not only that, to put that money into the best and greatest use for you each day. If you have questions about this, visit us at www.sustainablewealthsecrets.com. Go to the contact page, ask your questions, and I'll be happy to put a podcast together for you or write a program. I've got more than 22 years of newsletter materials. Some of it is unpublished. I would love to take your question, go through my old materials, go through new insights, refresh it, and get you an answer that you can take action with. Because again, it doesn't matter how much money you earn. It doesn't matter how much money you've got in the bank. All these things can change overnight. What are the principles, ideas, and concepts that help you sustain wealth over a long period of time to turn a high income into net worth? I want to thank you for listening. Be sure to like and subscribe, and I'll see you in the next episode.